So yeah, a little educational session today. We're going to do more backtesting on Friday, I believe, but today going to be talking more about risk management, kind of how I use it with both backtesting considerations as well as actual trading accounts. So we'll kind of start off with how I use it when I'm actually inputting the backtesting. Obviously, when you guys are recording the trades in FX Replay, you have quite a few options, how much to risk per trade, whether you do initial balance or current balance. And personally, what I generally do is I'll do a $100,000 account and I'll do 1% of initial balance. And the main reason for that is when it comes to analytics over a large period of time, if you do compounding, you're going to see like a pretty exponential equity curve, and it's going to be kind of hard to see how the equity curve looks like early on in the chart, assuming you have a profitable strategy. So with a kind of fixed 1% of initial balance, you should see like a pretty nicely, steadily increasing equity curve, which is more of what you want to see. You don't want to see a super volatile up and down chart all the time. So it doesn't matter if you use a 100K account or 10K account, but I personally recommend 1% of your initial balance so that you can kind of see the nice equity curve. And then also, when you come down here to the kind of performance by month, it's really nice if you're using like a fixed kind of essentially 1K or 1% balance or risk per trade, then every percent is an R. So you can kind of easily compare the months that, this month I had 6.9 R, the previous month 1.07 R. There's a couple months when we're slightly down, but if you're using, and you can adjust this if you use compounding or not, you can kind of adjust this to see, but I personally like to use the 1% of initial balance, so it's super easy to see kind of month to month how the results are comparing, instead of current balance when the later months kind of get overshadowed. So that's generally what I'll use when I'm backtesting, but that does not mean that I use 1% risk per trade when I'm actually trading. So for actual trading, I like to use this risk of ruin tool that I'll link to you guys in the chat real quick so you guys can play around with it as well. This is essentially a tool that kind of helps calculate based on some of the inputs for your strategy, the win rate, kind of what the average risk to reward is for the strategy, maybe how much drawdown your challenge or you're comfortable with, and it'll kind of calculate two risk metrics for you. One of them is peak to valley drawdown, and one is risk of ruin, and I'll kind of explain this too real quick. So if you think of these as like equity curves, as you kind of come up and have these peaks and valleys, the peak to valley metric is just that. Like from your high water mark at any point in time, it's calculating what's the probability that you will go down, however much drawdown percent you input here for this max drawdown number. So in this case, with these numbers that I've input, there would be a 7% chance that anywhere along the way I could kind of come down, I guess 10% in this case. And this is generally kind of what you want to use if you have a prop firm that has a trailing drawdown. It's going to kind of continue to follow you up as your equity increases. And then the other metric is risk of ruin, which is really just from any starting point. What is the probability that at any point from the time that you start, you will kind of go kind of 10% below that initial threshold? So in this, it kind of depends what the drawdown is, but essentially it's saying, what's the chance that you could be up 30%, but what's the chance from the very beginning that you start that you will go down kind of that max drawdown threshold? So in this case, kind of from the bottom here, that 10%. And so what I like to do with this tool is kind of adjust my risk per trade based on the model I'm trading and the constraints that I have. So if I'm curious if you guys have any prop firms or specific challenge metrics. We can run a few of these here, for example, but let's say, for example, you're trading on maybe FTMO. I believe they have a 10% drawdown constraint, and so if we were trading a strategy that was 50% win rate, average of 2 risk to reward, my kind of main goal is to get this peak to valley drawdown number under 5%. I think that's like a pretty conservative amount. So if we drop this a little bit lower, maybe 0.9. So I think we could, you could pretty reasonably use 0.9% per trade on an FTMO account, kind of using these metrics with the 10% drawdown. If you were trading futures on Top Step, they only have on a 50K account, you've only got $2,000 of drawdown. So it equates out to 4%. So obviously for those, you need to drop the risk per trade pretty significantly. I believe 0.4%, no, a little less than that, 0.3. So if you're trading something like Top Step, I think like 0.35% risk per trade could be like a good amount to use. And so if you're doing a 50K account, what does that come out to? 0.035. So like 175 per trade if you're doing a Top Step account with these metrics. Again, the nice thing with this is if you have different strategies with different metrics. I mean, I have some in here that I can just put these in. So this is a strategy that I'd made on gold, had a little higher win rate, but the slightly lower risk to reward, 1.63. So if I input those, 64.5 and 1.63, and let's go back to FTMO because I was initially trading this with CFD prop firms. Let's see how this plays out. So I can go a little higher with this one, 1.2. The nice thing is you can kind of input the metrics for your strategy and then just in the drawdown for kind of whatever challenge you're doing. Or if you're trading personal funds, this is obviously kind of more discretion. You know, maybe you don't want to lose more than 20% of your funds or something. You can kind of play around with it. But for challenges, all the different prop firms are going to have specific drawdown limitations that you have to kind of stick to. So you can kind of input those and put the metrics from your strategy within FX Replay, kind of at the top here. And then, so yeah, it looks like if I was trading this gold strategy, I could use maybe 1.5% per trade pretty comfortably. A little less than that. I will say kind of a couple considerations. One, even if these are the metrics you got for your strategy, the reason that I like to do less than 5% is to add a little conservatism, because number one, you're not going to trade the strategy perfectly. You'll probably miss some winning trades, close some trades too early. Maybe you won't size correctly on some trades. Like, as humans, we're not going to execute our strategies like 100% in line with the model. So adding a little conservatism so that there's next to no chance that you'll get peak to valley drawdown when the risk of ruin is really the main one that does matter more. And then second of all, if you are trading crypto, I really think you need to try and factor in fees, because crypto fees are pretty insane. And so I believe FX Replay did just recently add the ability to add spreads and commissions. So if you're starting to backtest more crypto edges, I definitely recommend it for those. I don't honestly think fees are that significant for most futures and CFD pairs. Maybe if you're scalping with incredible size, or the broker you have just has like pretty high fees. If there's anything where the risk per trade is more than like 0.1 R, then I would definitely try to factor in fees more, and so maybe try to adjust these or make them a little more conservative. But overall, I would say that you can kind of input the metrics from FX Replay in here with the drawdown for whatever challenge, and this is like a pretty good rule of thumb for kind of what risk per trade might make sense for your challenge. And then there's also considerations kind of for challenges versus funded. So yeah, we'll talk about that right now. So obviously with something like an FTMO, you have, I believe it's 10% the first phase, 5% the second phase, and then obviously you're funded and you're just trying to kind of make profits with that. My general recommendation is honestly to trade the challenge the same way you plan to trade the funded, because inevitably, however you trade the challenge is going to carry over to your funded accounts, and it's better to kind of trade them the same so that you don't carry over some bad habits of over leveraging or something once you're in that kind of live funded environment. And then kind of vice versa, if you're not trading consistently in the challenge either, that's going to carry over to the challenge, to the funded account as well. So what else did I want to talk about? So when to scale up and when to scale down. So obviously with prop firms, you have the ability to get multiple accounts or larger accounts. And my recommendation for you guys that are trading prop firms is, until you have proof of concept getting funded with an actual prop firm account and getting to a payout, there's no reason that you should be spending money on like multiple accounts or larger accounts, you really should wait until you have that proof of concept. Otherwise, you're likely kind of wasting money. I wish somebody had told me that when I was first doing prop firms, because I would have saved a lot of money until I'd gotten that proof of concept. And then really like scaling the risk per trade, the kind of main considerations there are, say that you're in a period of drawdown with a prop firm account, and you're debating like, should I scale down or should I kind of just keep it going? Oh, just get a alert. Should I keep it, what I've been risking and kind of risk blowing the account, or try and scale down? And the main consideration there is like, is it cost prohibitive for you to get new accounts? And most prop firms, it's relatively cheap to get new accounts. So it may not make sense to, spend months to kind of get out of drawdown and get to a payout, when you could, look for a high probability setup and kind of go your standard risk. And if you blow the account, you kind of try again. But if you've spent significant funds to get the capital that you have and you really can't afford to kind of re-up it, then that's probably a time that it makes sense to scale down. Maybe at that point you can kind of see, okay, what is my drawdown that I have left? Maybe I've only got like 3% left, and I'll kind of rerun these metrics and kind of start from there, scaling down. And then what I like to do in terms of scaling up, whether you're getting out of drawdown or maybe building profit buffer, is once you've kind of gotten some profits, wait until you have a few losses, and then kind of rerun the numbers to scale up. Because I've done it multiple times where I've hit some nice wins and then I immediately scale up, and then the losses are bigger at that point. So I think if you're scaling up risk per trade, whether it's on a prop firm account with profit buffer or a live account, I think it's good to build some profits and then wait for a period of drawdown, and then kind of rerun the numbers, and you can increase the nice psychological trick there as well, is it'll actually make you look forward to periods of drawdown. So that'll allow you to scale up. So that's kind of another good tip with that. And then if you're trading live funds, obviously there's kind of more reason to scale down, because this is your live money. You don't want to continue losing. So for whatever reason, if you're on kind of a cold streak from execution or the model, it may make sense to kind of scale back a little bit when you're kind of draw down, and then vice versa. If you're doing really well and you're in some nice profits, and maybe add some fuel to the fire and kind of scale up. So those are really the considerations that I would say on when to scale up and down. And then kind of the last thing I wanted to share with you guys is maybe some protective rules to consider that might help you if you're experiencing overconfidence and trying to prevent tilting. And some of the most common ones that I've seen with that are whether it's a dollar threshold per day, that if I hit this profit target for the day, like I'm done. And Top Step, for example, you can actually like lock yourself out of the account, which is nice. Oh, and vice versa. If you have like a daily loss limit that you don't want to lose more than X dollars or X percent per day, if you hit that, then you need to stop for the day. Kind of another way to capture that is by trades. Like if you hit a winner for the day, you can stop after that. Or if you have two losers, that's like I see some other people like kind of stopping for the day after that to prevent revenge trading and tilting. And then something that I used to do when I first started trading was, if I'd had like 2 losing days in a row, then I would take a day off just to kind of like mentally reset and like emotionally reset, make sure I didn't go that third day and like kind of blow my accounts revenge trading. So that's kind of all I wanted to talk to you guys about risk management specifically. Were there any questions you guys had related to the risk of ruin tool? Do you have any like specific metrics from your models you want us to put in here, and we can kind of see what a good risk per trade would be? Or anything else? Any questions on any of the other concepts that I share with you guys? Cool. Well, yeah, hopefully this is helpful for you guys, both to kind of standardize, I guess, your backtesting and maybe get a little more consistent metrics so that you can better analyze things over kind of longer periods of time, and also like translate your model to your actual live trading, because I really think it makes sense to adjust your risk per trade based on the model and based on the constraints that you're dealing with, whether that's a specific challenge. And then, make sure to add a little conservatism again, because you're probably not going to trade your live account exactly to a T as your model. But yeah, let me know if you guys have any other questions in the chats. But otherwise, I'll catch you later. I'll talk to you later, guys. Bye.